All right, everybody, here we go with the notes for Chapter 2, talking about the media business environment. And to start things off, I want to kind of get you into this mode of thinking that media managers must understand basic market economics, and they must understand business models in the markets in which they compete for audiences and advertisers. As much as we tend to forget that this is the case, we are in a business and we're trying to compete with other businesses that are doing the same thing that we are. So we have to kind of understand the whole economics of it all, at least on a certain level, to help us to be able to be effective at the jobs that we do when we are in leadership with a media company. Understanding the characteristics of the market will help management to develop strategies regarding content, advertising, branding, and emerging digital platforms. So you have a sense of what's going on around you and about you. You have a sense of what's going on in the industry. And those things together, in addition to all the voices that you're listening to, from the audience to the executives above you to the employees around about you, all of that, having a sense of how to deal with all these different things is really going to help you to be able to know what the next step to take is going to be. Economists define a market as a place where consumers and sellers interact with one another to determine the price and quantity of the goods being produced. A market consists of sellers, buyers, and products. Makes sense, doesn't it? Kind of hard, again, to kind of realize what that is when we're talking about something that's intangible, like media consumption. You know, you can't hold it, you can't feel it, you can't smell it. I mean, you see it, you watch it. Once you've seen it, once you've heard it, it's gone, pretty much. Except in the case of, if you have something on a DVR or on the computer, you can always rewind and that sort of thing. But for the most part, once you've consumed it, you've consumed it. And really what we're selling, what we're providing, is an opportunity of the use of one's time. And that's something that's kind of a challenge here that adds into this mix of what it is that we are providing, what is the good, what is the service that we are offering. Many media firms function in a dual product market. That is, while media companies produce one product, they participate in separate good and service markets. So here's what we mean by that. In the first market, the good may be a radio format, a TV program, a cable channel, could be a website, but the content is really targeted to consumers, and consumption is measured in different ways as to how effective it is, how many people are consuming said product, on and on and on. So, and I think that's one that most of us tend to think of as, when we're listening to a radio station, when we're watching a television station, when we're consuming stuff on YouTube and Hulu and whatever else, it's there for our enjoyment and for our pleasure as consumers, as viewers, as listeners. But the second market in which many media companies operate involves the selling of advertising. It's what brings the revenue in. As the demand for it rises, companies charge higher prices to increase revenues and profits. So the more popular programming content is, the more that consumers watch or listen, the more valuable the product becomes, which means they can raise the advertising rates and expect more revenue from companies wanting to advertise. Now, in addition to operating in a dual product market, traditional electronic media companies operate in specific geographic markets. The potential audience in this case is limited to the population within the geographic boundaries of the market. So in this class, we're going to use market in both an economic sense and in a geographic sense. And normally when we talk about market in media, we're talking more about the geographic aspect. Sometimes we're also talking about a certain demographic in terms of a market as well. So that's kind of a third one. But by and large, many times when we're talking about traditional media, and anyway, radio, television, you can lump cable into this as well. We're talking about certain geographic areas. Most of us live in the Raleigh, Durham, Fayetteville television market, for example, and that is a specific number of counties within North Carolina and actually includes a county in Virginia as well. So that is a geographic space that we call a market. So you need to keep track when you hear the word market, which market are we talking about? Are we talking about the economics? Are we talking about the geography? Are we perhaps talking about a certain demographic? The number of sellers in a particular market, as well as the extent of the competition among suppliers for buyers, is affected by the characteristics of that market. Media economists refer to these characteristics as market structure. So it's basically kind of the intricacies of the things that are going on. What sort of things in particular can you say to describe the market that you're in? How much competition is out there? How much in terms of availability of potential clients are out there in terms of increasing advertising dollars? All those sort of things help to develop a market structure. Let's take a little more look at a market structure right now. Though the structure of a market depends on many factors, several important criteria will help to identify the type of market structure that we are working with. Let's take a look at a few things here. First off, concentration in the market. A market is considered concentrated if revenues or circulation are controlled by a limited number of companies. So basically what that means is that there's a limited amount of places to be able to go for consumers in terms of what's available to them and in terms of advertising folks looking for different options to be able to give their information to the public. So the more concentrated it is, the more limited in the number of options that you have available. Though concentration can be measured in various ways, there's two approaches that are common in media industries. One method, using ratings data, calculates the share of the market reached by each competitor. Now, I should explain something here with this statement from the textbook. This is somewhat confusing when we talk about rating and shares in some of our other classes. And really, I don't think the textbook does a really good job here. Ratings and shares are two different values of audience measurement. And they kind of talk about them like they're similar. There are some similarities in that they're measuring the amount of audience relative to the amount of available audience. However, the basis on which you get a ratings number versus a share number is very different. So they're not really synonymous with each other. They're only synonymous in that they're similar. What ratings do is tell how many people are consuming a certain type of content relative to the population of a certain area. Whereas a share number is going to be the amount of people that are consuming a product relative to the number of people that use that particular type of product. So you'll get more of that in detail in some of your other classes, but just know that while ratings and shares are similar in scope in what they try to do, they are not exactly the same thing. Another method involves calculating the percentage of revenues or sales controlled by the top 4 or 8 firms. This type of measure is known as a concentration ratio. And a market is considered concentrated if the 4-firm ratio is equal to or greater than 50%, or if the 8-firm ratio is equal or greater to 75%. Basically what that's saying is that if the majority of the revenue is going to a limited number of companies, that's when they say that a market is it's considered concentrated. So if that makes sense, think about it as like if a couple of networks were like name brand clothing and everybody's spending money on the name brand clothing as opposed to the knockoff generic brands, if you will. Then the name brands would have a concentrated market on that particular product. Same sort of thing here in media. If there's really only a limited number of companies that are getting the vast majority of the dollars, then we consider the market to be concentrated. Product differentiation refers to perceived differences among products. Because many media products can be substituted for one another, product differentiation becomes important. So what we're talking about here is helping consumers, helping advertisers to choose your brand, to choose your products and services, to choose your programming offerings over top of somebody else's, making yours stand out and saying yours is better than someone else's for such and such particular reason. Now, some of the ways that happens, in radio, for example, they'll offer unique formats targeting specific demographic groups. An advertiser that's looking for an older audience may choose to air their content on more classical type stations with classic rock, classic country, that sort of thing. Some easy listening type stations may be included in that as well. If they're trying to reach a wealthy audience, they may go for a commercial jazz format or perhaps a news talk format. If they're looking for a younger audience and they're promoting something that they believe is rather fashionable, Top 40 or CHR would be a good choice. Television stations, they differentiate their local programming, especially with news. So the way that the news and other local programs are presented on the station helps to give that station its signature in the particular geographic market that they're in. Broadcast networks and cable services distinguish themselves through their individual program schedules. What are the offerings on that particular cable service, and how many of the different channels can you string your advertising through? What sort of strategies can you use throughout the cable service? In terms of one example is a tactic called blocking, where you air a commercial at the same time on every network that is possibly available by the cable service, or at least several of the different channels that are available. And there's all sorts of different other strategies that work within that as well. As far as social media, other digital platforms, they target specific consumer interests and offer opportunities for users to interact with one another. Interactive ads becoming more and more of a thing, inviting consumers to click here for more information or to even interact with the ad itself. Some barriers to entry. These are obstacles news sellers must overcome before they can enter a particular market. In the media industries, these barriers often take the form of capital investments. It takes a lot of money to keep up equipment, to get equipment in the first place, to hire staff, to come up with programming content, especially for television, brokering agreements with various syndicators. That takes a lot and a lot and a lot of money. Even to produce programming locally is going to take a good bit of money with equipment and personnel. Most digital platforms require much less startup investment. Websites are cheap to establish, but they can be costly to update and maintain on a consistent basis, especially as the website and the services grow. You're going to need more bandwidth as more people try to log on to the site. You're going to need more space available to be able to hold a lot of data, especially if you have video data that takes up a lot of space. Anything that's interactive in nature. So the more that your website becomes popular, the more you need to invest in the infrastructure of that website, which makes that more and more expensive. Sometimes a barrier doesn't involve money at all. Sometimes it's regulatory policy that causes problems. Rules from the FCC, Federal Communications Commission, FTC, the Federal Trade Commission, they get involved with some of the rules and the ethics concerning advertising. Following those things. Other association rules, like if the station is a member of the National Association of Broadcasters or various journalistic associations and their standards that need to be maintained there. Those things can also cause roadblocks. Cost structures are the expenses needed to create products in a market. Total costs represent a combination of fixed costs and variable costs. So fixed costs, those are the ones where you know that you need such and such a thing costs this much. And that's going to be a rather consistent sort of thing. Variable costs, those are things that the price of those items can change from point to point and time to time. Things like the cost of labor, the cost of certain raw materials. Anyone that has tried to pick up raw materials from a place like Lowe's or Home Depot or something like that has seen how the costs of various items can fluctuate wildly, especially in the past year to 18 months or so. Vertical integration occurs when a firm controls multiple aspects of the production, distribution, and exhibition of this product. This is one way to try to mitigate costs in a certain fashion if you don't have to outsource certain things such as acquiring programming or distributing that programming. If you've already got the structure built in where you have media outlets in several different markets, you have a built-in distribution structure. And a lot of the corporate entities, especially like network-owned and operated stations. In radio, you have large corporations that have stations in multiple markets. So the more that you're able to do in-house, the less it is going to cost in terms of producing the content, getting the content out there, the cost of acquiring that content, and on and on and on. Four main types of market structure. Here we go. In the monopoly, a single seller of a product exists and dominates the market. A true monopoly offers no clear substitute for the product, and buyers must purchase the good from the monopolist, or they must forego the product altogether. If there is no other place to get the thing, then you either pay what the owner wants you to pay for the thing, or you don't get the thing. Plain and simple. A market dominated by a few firms that hold a similar share is called an oligopoly. Such firms are interdependent, that is, the actions of the leading firm usually affect the others, and as such, these firms consider their actions in light of the impact on both the market and on their competitors. For a long time, broadcast television networks were considered an oligopoly. You had ABC, CBS, and NBC. And if one of those networks decided to do a thing, it wasn't only going to impact that network, but to a certain degree, it was going to impact the other two as well. So just as much as they were competitors, they would also kind of, sort of work together to protect their interests while at the same time protecting the interests of the other networks. And this happens in terms of smaller broadcast markets with individual station owners. It happens with certain distribution firms and etc., etc. If you only have a couple of major players, it's almost essentially between that small handful of companies, they're a monopoly, even though it's not technically a monopoly. So we call it an oligopoly. Third type of market structure, monopolistic competition, exists when many sellers offer similar products that are not perfect substitutes for one another. Each firm attempts to differentiate its products to the consumer via advertising, branding, promotion, location, service, and quality. So this is where you have a product that does a certain type of thing. Then you have another company that has a similar product that does a similar type of thing, but it doesn't exactly 100% replace the first product. And then you have other companies that are doing the same thing, but there's not necessarily an apples to apples match that completely fulfills the what the product can and cannot do across the board. So in that sense, there's monopoly in the sense of certain proprietary constraints is a great example, where one good example of this would be certain streaming services, where the streaming services in and of themselves offer a similar product, but streaming service A exclusively offers this particular type of content. Streaming service B offers exclusively this particular type of content, and on and on and on. One of many examples there. Multiple sellers and a homogeneous product characterize the market in perfect competition. When no single firm dominates, barriers to entry do not exist, and individual companies operate as price takers in the market because buyers establish the price for the product. The consumer is in the greatest amount of control in this sort of environment because they can choose what they are going to purchase and not, because there are several options available that will meet their needs. So this is a good point for us to take a break. When we come back, we'll continue on with Chapter 2.